how do you find someone that's reputable and or ethical and or going to do what's right by the client? Quite frankly, it's through reputation. If you bought a stock at 15 cents and you're calling me and it's trading at $2 plus, and you'd say, I'd like to sell some, I probably inclined not to stop you. I think we'll see capital gravitate towards the large cap gold producers first, and then eventually, but surely slowly, a trickle down to the gold explore codes. You know, this business is so cyclical. Like you could be too early, right, into a commodity or into a trade, and it's effectively the same as being wrong. I just don't necessarily want to keep adding capital to a theme just because it's, you know, it's hot. How do you put yourself in the best position possible as an investor for success in the space? There's no secret formula. If you're a retail investor and you don't work with a full service broker and you're, if you will, a do-it-yourself investor, I would say go out there and educate yourself.
Right, Justin Hayek from PI Financial Corp. I believe you're the first broker that I'm going to be interviewing, or well, yeah, the first full-time service broker. What would you call yourself? Are you a full-time service broker? Is that what you guys call yourself?
Correct. Yeah, full service broker.
Okay. Okay. Well, I've been told that it's really you guys, so the brokers, who make the money in our space. So maybe we can start off there, but maybe start off more simply, because I know very little about full service brokers, and I just imagine you're someone in a suit with stripes on it and pushing stocks to anybody and everybody out there smoking big cigars. So is that true? What does a broker like you even do?
Yeah, so maybe I'll touch on that first point that you mentioned. So the brokers make all the money. I would say that's far from the truth. You know, maybe give you a bit of background and context in terms of the industry and how competitive things have become. So, you know, what really separates a full service broker from online discount trading platforms and so forth, really, as the name implies, we are full service brokers. So, you know, I can speak to what PI has to offer in terms of services and or products, and basically full suite from, you know, products as low risk as GICs, cash management, to as speculative as venture capital, risk capital, right? And everything in between. And each advisor has the capability, the flexibility of developing their own business practice. So what I mean by that is, you know, some advisors at PI focus on more blue chip type of investments, whereas I focus more so on venture capital.
Okay. Well, and so you said that that's far from the truth, that you guys make all the money. How come? What do you mean? Who makes all the money then? I got to find them. It's not me.
Right. Yeah. So, I mean, look, hard to quantify it, put it to you that way, but hearing stories from, you know, people that I know that have been in the business for, say, 20, 30 years, the fees that the brokerage firms could charge at the time, say back in the 80s and 90s, were significantly more than what they could charge today, right?
What do you charge? How do your fees work?
Yeah, so if we're, say, dealing with a client, right, and it's a transaction or a commission-based account, basically it's a percentage against the gross value of the trade with a minimum value imposed. So as an example, let's say if somebody put a trade through that had was, you know, 10,000 shares at $1, right? We, PI, impose a minimum commission on that, which is effectively $90. But then the rate in which the client pays to the broker is more or less negotiable, right? You know, it's generally speaking probably between 1% to 2%, depends on the value, the size of the trade, depends on the frequency of the client's kind of activity, the relationship, the tenure, and so forth.
Okay. But that's one side of it. Like, that's how you make money from your trading clients. But I suppose you also like raise capital for companies, and then you make money on the issuer side too, basically.
Yeah. So let's say exactly. So let's say an issuer is raising capital through a financing, be it non-brokered or brokered financing. So the issuer in this instance pays the broker dealer a commission for basically introducing the investor, i.e., the client, to the issuer. And so I would say, you know, without knowing everybody's, you know, business practice, IAs that is, and or depending on the brokerage firm, the broker dealer, you know, that's probably where a vast or a good portion of the commissions and or the revenues are derived for the broker dealers. But, you know, that's to each his own. It depends on the business practice too.
Finder's fees, essentially.
Yep, correct. Finder's fees and everything, look, is publicly disclosed, right? In a news release, if a company, ABC Exploration announces that they are conducting a financing, non-brokered private placement, there's fees payable. Usually, or I'd say most of the time, they'll declare what the finder's fee payable is to the broker dealer. Um, and yeah, it gets disclosed as well at the when the financing closes in terms of how much was paid out in the form of finder's fees, right? All of that stuff has to be disclosed and is very transparent.
Right. I want to touch upon that. But again, just sort of go back to the first point that we were talking about, that it's not brokers who make all the money, but it sounds like there is a good chunk of money to be made. Who do you then think makes all the money if it's not the brokers?
Look, I think it depends, right? Because there's certainly people on the issuer side, those that funded the company from inception. So be it the promoter, the CEO, that obviously they'll have 99.9% of the time the cheapest paper on the cap table. If the company does well and it's a nice clean exit, and company from a share price perspective does very well, I mean, they'll make far more money than anybody else, right?
Hmm.
I would say maybe the best analogy that I can think of is that you hear about the stories of the gold rush in California or in Alaska, right? And who are the people that made or benefited the most from that? It's the people who sold the pickaxes and the shovels,
Hmm.
right? Maybe there's some element of truth there, because obviously not everybody is going to be successful when it comes to making investments. Obviously, there are some select few. When again a deal goes very well, they'll do very, very well. But yeah, no, the industry as a whole, I would say, just given maybe to kind of further add some context, the industry as a whole, the broker dealers, independent broker dealers, I would say hasn't really done all that well and hasn't been making money, because I can speak to at least 3 transactions that PI has been involved with where we have acquired other companies, other broker dealers, for very, very kind of reasonable to cheap valuations or terms. So it's now become much more competitive for the industry, or within the industry as a broker dealer, because there is competition from the online discount platforms, the interactive brokers of the world, and TD Greenline and so forth. So is it fair to say that the brokers make all the money? No, I would suggest not at all.
Hmm.
There's a lot of overhead, there's a lot of compliance costs and oversight that is necessary to run a broker dealer. So there's there's a big number every month that the firm has to generate in terms of revenue in order just to break even.
Hmm. It's also, I just came back from PDAC today, actually. So I'm still kind of sleepy if people are wondering why this is even worse than usual. But founders shares make most of the money typically. I mean, sometimes you'd see shares that are at a millionth of a penny, which is like 0.000 and so on, 1 cent per share. And then they list it for 10 cents or even $1 or whatever it might be. But also, as you mentioned, service providers, so drillers make money. Drillers, typically private companies, but drillers make astonishing amounts of money. Like there's drillers out there with 9-figure balance sheets that you've never heard about. I mean, you have, but I hadn't heard about. So yeah, I can see how they potentially make more money. But for you, essentially, you are incentivized to have your clients trade as much as possible. Or as far as I understand it, retail investors are better off trading as little as possible. So how do you balance making money with your clients making money too, basically?
Yeah, I think really it comes down to ethics, right? Is someone as an advisor going to be ethical in terms of their business practice, right? I suppose you could probably have the objective of trying to make your clients, or have your clients as active as possible to your benefit or to the firm's benefit, sure. But really, from a business practice point of view, what's the longevity of that business look like then? Or your ability to, sustain a business and or maintain a reputation and sustain a business over the long term. What does that look like? I think pretty quickly, clients might start to recognize what's going on, right? Is this really necessary? Questions start being asked. So I think those people, probably IAs or advisors, probably get phased out either very quickly or through the course of time, where it's very evident in terms of what it is exactly they're doing and the fact that it's not to the best benefit of the client.
Mm. And but ethics are kind of hard to quantify, right? Like how do you see that as me looking for a broker out there? How do I know my broker is ethical? Because most people will lose money in this sector. Most retail investors will lose money in this sector. But again, the broker will make some on commission regardless whether they make or lose money. So well, I guess have you ever had a moment where you tell someone, "Hey, don't buy this, even though I'll make a commission on this. This is too risky for you, so back off." Like, have you said that?
Yeah, absolutely. Absolutely.
Mm,
And look, I mean, over the course of probably the last 15 or 16 months, we've been very quiet in terms of level of activity, certainly compared to 21 and 2022, right? Part of that is because, just given the context of how well or poorly the TSX venture has done, people aren't necessarily inclined to trade and or invest further. But also part of that was in a way by design, and referring back to spring 2022 when things were getting a little hot, if you will, in the sector, and there was a number of financings. It was pretty rampant. Just about anything, if you will, was financeable. Spring of 2023, and just took my foot off the gas. Simply put, like it
mm.
just didn't feel right. And so, again, having more of a long-term kind of outlook to the business, I think is key and important. To your question about how do you find someone that's reputable and or ethical and or going to do what's right by the client, quite frankly, it's through reputation, right? Vancouver, as large as it is, certainly the industry is within Vancouver. We are the hub, if you will, for venture capital, but it's really quite small. Either I know someone directly, or I'm perhaps one or two people removed from knowing about that person or knowing that person. And so reputation gets around pretty quickly here in Vancouver, specifically within the segment of the industry of those advisors and or those management teams that are, in the mining sector or specific to venture capital. Like it's not too difficult to get the down low on someone, if you will.
Yeah, I can see how that's true. I've never been to Vancouver, but I've been told it's sort of like more village than it is a city, if you will, especially when it comes down to mining. And everybody's always talking about mining, apparently in coffee shops and restaurants and whatnot. And that also results sort of in this you scratch my back, I'll scratch yours type of effect, which has also got me thinking about the broker reports, right? There's these research reports that brokers write, and there's a buy or a sell order on there. Typically, it's a buy. Typically, it's a share price that's much higher than the market price because maybe in the future, maybe you're already raising capital with that company, or in the future, you hope they're going to raise capital with you. So, well, that might actually be a point to talk about. How do you look at broker reports? To the unexperienced eye, they look like these very fancy, official, professional documents. So whatever is in there must be true, right? But oftentimes there is that bias. So how do you guys also write reports? How do you look at broker reports?
Yeah. So maybe to clarify too, by broker reports, we're going to refer them really as analyst reports, right? So I don't write
Okay.
any official reports to put out a price target or anything like that. But analyst reports, I suppose there's certainly some analysts better than others, right? And I'm sure there's biases that exist. I mean, look, there's biases from the sense or the perspective that, okay, maybe they really like the management team, right? Immediately there's a bias there. Or maybe they really like the geographical location or jurisdiction or the commodity, right? And maybe quite frankly, they're wrong, right? Like that, there's obviously that possibility. As far as maybe addressing like whether or not there's a conflict of interest there, I think is kind of the heart of the question. There's Chinese walls, if you will, is what we refer to them as, Chinese walls in place to separate the research department from institutional sales and retail sales. So there really shouldn't be any interference on the part of the sell side of the business with the analyst's recommendation and or interpretation or how they see an investment opportunity.
There shouldn't. You said it properly, but That doesn't mean there isn't, right?
I suppose. I mean, look, I'm not on that side of the business to kind of oversee, well, how does this get handled or managed accordingly? And certainly I can't speak to how other broker dealers,
Mm.
oversee that. But there shouldn't be, in theory, right? And maybe I can speak to as an advisor now, because I tend to gravitate towards and or work with certain management teams more closely. Maybe is there a conflict of interest there or a bias on my part? I would say no, but with the caveat or understanding that if I want to work with a management team, like a specific management team or groups of management teams, it's because I think it's in our best interest to do so, right? The management teams that have a track record, that have the resources and the skill sets, the capabilities to execute on whatever it is, in terms of an effort or endeavor, they're working on. So whether it's exploration, development, production, and so forth, right?
Mm.
So I would say, there's some people that perhaps are more conflicted than others. Some, um, you know, more inclined to, as you put it, scratch my back and I'll scratch yours. But I think, again, looking at the business from a long-term kind of perspective, the people who will do right by the client and for their business practice will, probably succeed over the long run and or not fall into those pitfalls.
And I think it comes down to, well, first of all, case per case basis, but also I just believe it's important to be aware of those biases. In your example, specifically looking at your Twitter page, your background photo is you ringing the bell with an issuer. Let's say you're raising money for that issuer. Well, you're clear with that. You're clearly close with that management team. I should be aware of that bias myself, and I should just sort of take it into account when I'm making my decision. That doesn't mean you're necessarily going to sort of rip me off to the benefit of the issuer, but it just means that there is a certain level of bias there that people should be aware of. That's kind of how I look at it.
Yeah, no, look, I think that's fair point. Again, like I tend to gravitate towards the management teams that I'm most comfortable with, but comfortable with in the sense like in a professional manner. Like I want to be affiliated or associated or work closely with a particular management team. So it's obviously very out there that, with that particular issuer, I was very involved kind of from the get-go onwards. But also keep in mind, if I'm biased in something, it's probably because I believe in it, right? I believe in the management team. Again, I believe in, be it the project itself or other factors and criteria in terms of why I might be biased and or have kind of a positive outlook on it.
How does that work, by the way? Because we mentioned at the beginning that founders shares make most. Um, do you ever get any of those? I mean, if you're close with an issuer from the get-go, maybe you get involved in a private deal, you help them take it public, and then do brokers also participate in founders shares?
Sure. So founder shares. I mean, there might have been one or two, probably a couple times where, if you will, I've been offered to participate.
Mm.
Um, it's certainly the case where, I mean, look, I think with any investor, probably want to be shown the opportunity as soon as possible. At least that's my preference. And as soon as possible from a valuation perspective, as soon as possible from kind of a public company or company creation kind of process. So yeah, I would say there's definitely opportunities that get shown to, I would say, not just advisors, but people in the industry, right? Kind of across the board, to say, I'm creating this company from scratch. It literally may be just an idea or concept at the time with no real business plan, no asset even, right? Like there's obviously a very high degree of risk that
Mm.
comes with that. And pretty well every single time, of course, if it's a seed round or founder shares, it'll be a private company, which means even just that much riskier because the company may in fact never go public, right? And there may never be liquidity.
Right, right. Okay. To go back sort of to how do you know as an investor who to put your own money with and someone who's not gonna sort of use that against you or use you as exiting liquidity, like they get a millionth of a penny founder's share and then they list it at $1 and telling you to buy it, but maybe for their portfolio or their wife's portfolio they're selling on the back end of that. You go back to ethics, but what else? Like how do I look what would you look for? Like if you just stop being a broker tomorrow because you made a bunch of money, you want to go independent and you look for a new broker yourself, what are specific things that you would look for in a broker?
Yeah, good question. So one, I would want to have as my advisor, someone who has access to deal flow,
Hmm.
right? Who it will be that first phone call or one of the first phone calls from the quote unquote promoter of the company to say, I'm creating this company, today or in the process of doing so. I can get you an allocation in the financing and you can make it available to your clients. Like I would want my broker to have that kind of access. Um, that to me would be key, if you will, when it comes to venture capital.
Okay.
Yeah,
That's
obviously,
yeah, go ahead.
sorry to interrupt. Obviously, also it would have to be someone that you trust, right? You've got to be able to trust the person to know that, back to the question about morals and ethics, someone that you have full faith is doing what's right by you, right, by the client, and there's no, you know, nothing to suggest otherwise, right? Like you don't want to be dealing, this applies, I think, to any business or any product or service that you're buying. You certainly don't want to be dealing with anybody that you might believe you're being kind of screwed over, if you will, right? So I think those two factors to me stand out as qualities and or qualities that I would want to see in an advisor.
Well, that's exactly that part that I want to talk about. Like, how do you? That's not necessarily a quality. That's more of a gut feel type of thing. But how do you see? Like, you look at their mouth, and if it's moving, then you don't trust them, or like, how do you judge it?
Yeah. So in my experience, thinking about the advisors that have been a part of, you know, success stories, if you will, in the business, and why is it or how is it that they continue to maintain this kind of long-standing career, right? Um, yeah, I honestly I think it just comes down to reputation, right?
Hmm.
Nobody wants to be affiliated with anybody that could be perceived as, all strong word, but like a crook, right? Nobody wants to be taken advantage of. And again, Vancouver, despite it being, as large of an industry as it is, it's very easy and very quick for a reputation, for you to develop a reputation, and that to be, just kind of common knowledge, if you will, within the industry. So, I mean, I would say it's certainly more difficult if you're outside of the city or outside of the industry to kind of sift through and filter and figure out, the real ones from the not so real. But at this point, at least in this stage of my career, um, it's not too difficult for me to find out in terms of, again, someone's history or track record and or their reputation.
Okay, so you look at track record. You're basically calling your network to figure out what the good and the bad deals were that person has done. Yeah, like that's tough if you're again if you're just sitting like me, you're sitting in Belgium, but you want to find a broker. What do I do? Who do I call? My network has grown a little bit, obviously, through this that I'm doing online, but overall, I can imagine it being tough. Um, when did you start doing this again? When did you become a broker?
2007, I right out of university got into the industry.
Wonderful moment.
Yeah, literally peak market. Unfortunately, it went straight downhill from there. So never got to participate in any degree in that kind of first, bull market or resource market.
Hmm.
Then briefly through 2009, 2011 had some level of participation, but it hasn't exactly been the easiest kind of, period of time over the last 16, going on almost 17 years being in the industry.
Well, what is your track record since 2007? Talk to me about some of the good deals and some of the bad deals that you've done.
Sure, sure. Maybe I can speak to more so over the last, let's call it 6, 7, or 8 years since I've become taken on the role, I guess you could say, of being an advisor for our book of clients. Um, I would say this. There's a couple of things that really stand out to me in terms of looking back at what's worked for us, and what were some of the qualities or characteristics of those deals, in terms of similarities. One, standout management teams, right? So management team that again have a track record, have the resource, have the skill set to be able to execute in terms of whatever the objective is, be it exploration, development, or putting an asset into production, right? Also, I guess coupled with that too is the ability to raise capital. That's crucial, obviously, in this industry because it is so capital intensive, right? So the management team being invited, if you will, early on through the company creation process, be it pre-IPO or IPO level, where you're essentially either the cheapest paper on the cap table or very, very low in terms of the cap table, in terms of where you rank. And then basically kind of hitting, if you will, the inflection point of, let's say, a commodity like gold. It was flat over a period of time, call it through 2017, 18, 19, and then things obviously took off in 2020. So if you were positioned in the company, leading up to that, you were buying at a time that the valuation was cheap and or low, right? So I think at least those three factors kind of all contributed to us being in a position where, as shareholders, as investors, we got the greatest kind of upside, right? So, and these range from companies that were, operations, past producing gold mines that were acquired by, a new public company, and they were redeveloping the asset and putting it back into production, to grassroots early stage exploration for gold project, to advanced exploration development stage kind of asset. Like it's all kind of across the spectrum in terms of the type of asset or the life of the asset itself.
Those are all things that I want to touch upon later on. I was mostly thinking about specifics, like can you tell me names on things that you did well, or names on things that you didn't do well?
Yeah, sure. Maybe the one, again, because it's more kind of public knowledge out there. So Visa Silver, we got involved basically from, the ground up, and, participated and got involved in the IPO. I think my timing could be off here, but if I remember correctly, I think it was fall of 2018. Yeah, fall of 2018 or fall of 2019. There was only 3 brokers that had access to that IPO. Right, back to the point about what kind of broker do you want to work with, or that I would want to work with, is one that has access to deal flow. And so again, being one of 3 advisors that had access to that IPO, that put me in our book of clients in a good position to participate. And then the rest, as I say, is history. They made the discovery, I believe it was summer of 2020 at Panuco, and obviously they've gone on and had some pretty significant success since then. So that's an example of something that's worked out. Obviously,
what market cap did you get involved with? What was the market cap?
Yeah, if I remember correctly, I think the IPO was quite small. I think we raised about between the 3 brokers, that is, some $500,000. So the market cap at the time might have been, could be wrong about this, but maybe 2 or 3 million. Like it was micro cap.
Okay, it's 320 now. So what did you get out of this? Like, did you call your clients and say, okay, now it's time to sell, let's take some profits? Because it was much higher at a certain point, I believe. Let's see. It was more than twice as high in November of 2021.
That's right. It was, I believe, north of $3 at one point, briefly. We still have a position on the books now, albeit in full, transparency and disclosure. Not as large of a position as we once had, because clients were inclined to take some profits off the table. And, if you bought a stock at 15 cents and you're calling me and it's trading at $2 plus, and you'd say, I'd like to sell some, I'd probably incline not to stop you, right? And or at least suggest maybe take a little bit off the table, certainly. So again, that's an example, albeit that worked out really, really well. Of course, like everybody, we've had some investments that didn't work out so well, right? Sometimes it comes down to poor timing. Sometimes it comes down to management's mis-execution, and or other factors. So definitely had, unfortunately, shares of those, but I think that's venture capital, right? Very cliche to say, you win some, you lose some. Hopefully the wins that you have, of course, make up for the losses. And ideally, when you do have a winner, or you do invest in a winner, you're able to, or you're investing in something where the return is far greater than those losses, and makes up for it. Because again, we are absolutely going to have losses on the books, that there's no doubt of.
Hmm. How many deals do you typically participate in?
Yeah, good question. So 2023, I want to say we probably conducted in terms of financings where I was active in terms of making calls and reaching out to clients. It was a very small number. It's like three or four,
Okay.
no more than four. 2020, 2021, and 2022 more active. But I what I've tended to focus on is basically, generally speaking, want to have a very high kind of threshold, if you will, or yeah, threshold in terms of what will constitute something that's investable for us or something that I'm very comfortable in
Hmm.
approaching our clients with. And there hasn't been too much, broadly speaking, over the last year and a half that I found that I believe is a worthwhile investment. Whereas 2020, context of the market where things were running rampant, if a company was raising a couple $1 million, putting $1 million into the ground in the form of exploration work, but the ROI on that $1 million was 5 or 10x. Like, you put out a decent hole in a good market, your stock price, your market cap is going to go up, right?
Hmm.
Um, different environment, different strategy at the time. Again, really took my foot off the gas. Spring of 2022, in fact, in 2023, again, that brief period where there was some activity, a flurry of activity, but haven't been all that active for a little bit here.
So how do you survive in that moment? I mean, if you're not making deals, you're not making all that much money. I don't assume people are trading too much by looking at the volumes on the TSX and TSXV. Well, how do you make money right now?
Yeah. I mean, look, I think, and this applies to all broker dealers, the revenue numbers for 2023 are certainly not the same, or I should say they're significantly down from that of 2022 and 2021.
Hmm.
So that's across the board, right? It's a very cyclical business, right? That's very obvious. So it is what it is. Just come into the office every day, grind it out, look for opportunities, look for ways to hopefully add value, if you will, for clients in terms of making suggestions or recommendations, and or just kind of keeping in touch, keeping my finger on the pulse in terms of what's going on in the industry. Because um, you know we're what now, second week, going into the second week of March. Gold's turned pretty favorably here in the last 2 weeks. So if you haven't done your due diligence leading up to this point, you're kind of already behind the ball, right? So there's always something to be done. There's always something to be done if you're on this side of the business, where it's, again, keeping in touch with people, looking at deal flow, kind of keeping your finger on the pulse. Sometimes that leads to business being generated. Sometimes it doesn't, but that's just a function of the business.
Hmm. And deal flow varies with the cyclicality of the market. Okay, that makes sense. But
Yeah.
if you said that specific period of about the last 6 or 7 years, how many deals do you think you've done total? Like 30-ish? Would that make sense?
Yeah, it's probably ballpark that number, Antonio.
Okay.
Don't have the numbers in front of me, but if I had to guess, probably
Hmm.
about that number.
And so what I'm wondering here is that typically, the failure is not only the norm, but it should be the expectation when someone goes out to look for, hunting for a treasure that's buried in the ground and drilling big, sometimes $1 million holes. Failure should be the expectation. Should be the expectation. How many of those deals do you think have created shareholder value over that 6 to 7 years?
Yeah, so there was a period there when companies that we invested in or funded through 2017, 2018, 2019, they turned out to be incredible successes, at least from a viewpoint of, what kind of value was created for investors or shareholders, right? And how much appreciation did you get in terms of share price come 2020 and 2021, right? Um, hard to pinpoint a number down in terms of what percentage turn out to be wins versus what percentage turn out to be losses. But I can say definitively over the last, say, year and a half, there's been more losses than wins, unfortunately. So it's again a very cyclical business. What I'd like to do, or what we should all kind of, I think, strive for as investors, is before we hit that kind of inflection point, being in the price of commodity or turn in the market sentiment or whatever else it might be, we want to be invested right at that inflection point before things kind of turn, right? Timing, as they say, is everything. I wouldn't have thought or anticipated for the market decline to be as dramatic as it has since spring of 2022, nor lasted as long as it has. But here we are. But at least the last 2 weeks, things have started to look a little bit more favorable. So if you've done your homework leading up until now, maybe you got lucky, maybe you bottom ticked it and bought just at the right absolute time. But yeah, it's a function of basically, I think, doing the homework in advance and being prepared for, if you will, getting into those opportunities when you deem to be the right time.
Does your process change depending on where we are in the cycle? Like, for example, now there are many deals, everything seems cheap. So for example, I'm cranking up my criteria to only pick the very best deals, or what I think are the very best deals. So what I would maybe tolerate in a bull market, I wouldn't tolerate right now. So yeah, do you do that, and how do you do that?
Yeah, so what I have gravitated towards over the last, say, few months here, if I was inclined, or if a client was inclined to put some capital to work, is basically the higher end, if you will, in terms of the value chain or the food chain for, let's say, the gold producers versus looking at a gold explore co, right? I think if history repeats itself here, we'll find out over the course of time, but I think we'll see capital gravitate towards the large cap gold producers first, and then eventually, but surely slowly, a trickle down to the gold explore codes. So I think there's probably, certainly some sort of lag effect here from the time that the gold producers start to get a little bit of traction and love in the market and improvement in valuations, and then at some point that speculative capital, which goes into the explore codes, finally trickles in. So I think in terms of layering or sequencing, focusing on the, again, names that are higher up in terms of the food chain, and then kind of at some point here, slowly trickling down into the explore codes, where again, it makes more sense. Capital is more accessible, deploying capital in terms of exploration and actually getting or creating value for shareholders on the back of drilling success, because that hasn't really been the case over the last year and a half. You could have put out some decent results, and as the issuer, let's say somebody who's the VPX anticipated or thought, the market is going to reward us based on this success, and that not been the case, because guess what? There's no capital there. There's no capital for the gold explore codes, where it's so capital intensive. It's like, okay, great, you've had some success with the drill bit. How are you going to finance this next drill program? Again, unless the results are super exceptional, and there have been some issuers that have delivered incredible results over the last year and a bit, but generally or broadly speaking, it's been a very difficult segment of the market to invest in the last year and a half.
Yeah, the only thing that seems to work is sort of the 200 meters of 2.5 grams of gold or something like that.
Right. Again, exceptional results, right?
Yeah. What do you? Okay. Well, the exceptional. What would it take for you? Let's maybe put it that way. What would it take for you if I had an Explorer Co and I come to you and I say, hey, I want to work with you. I want you to raise capital for me. What would it take for you to start working with me right now in the market and go to your clients and say, hey, this guy has a good deal?
Yeah, it's a number of factors. Like, I couldn't pinpoint a number, specific in terms of a market cap or whatever it might be to say, okay, this is my specific criteria, but I can tell you the criteria which I look at. So for me, top of the list is people, right? Again, back to reputation, back to having the ability, the skill set to execute, right? Whatever it is that you're looking to, whatever efforts or endeavors, right? So people's top of the list. After that, it comes, they're almost all equal in terms of weighting, if you will, at least in my mind, is the project itself, right? Is it a project of merit, and or does it stand a chance in terms of possibly delivering favorable results? Is it something that's, topical or promotable, right? Is the market going to care? The price, what's the valuation, right? And then basically in terms of the access to capital and or, being able to attract capital to actually execute on the program, right? Be it exploration or whatever efforts, again, that they're pursuing. So for me, again, top of the list is people. So if it's somebody that I'm not familiar with, again, reaching out to my network of people within the industry that I know, that whose opinions I trust, to say, what are your thoughts on this individual, right?
Mm.
And then after that, it's basically asking the simple questions to management, and or be it not having a technical background as a geologist, putting, say the slide deck in front of some geologist clients that, again, whose opinion I trust, to say, what are your thoughts on this project? You've worked in this part of the world, or you've worked on this style of project. Is this something that is reasonable?
Mm. What do you do about geology more specifically? Again, you're not a geologist, but oftentimes geology can make or break a story. So sure, you can go to people who you trust, but what are sort of the main things that you personally look for when it comes down to a company's geological potential?
Scale.
Mm.
Scale, something that project in terms of the upside, to demonstrate there's scale there, right? So if we're in the business of deploying or allocating capital to a exploration company, right? Are you, as an investor, and is the market more interested in something that has, upside potential of, let's say, 250,000 ounces, or is the market going to get more excited about something with upside potential of, say, factor of 10, 2.5 million ounces, right?
Mm.
So scale to me is probably top of the list in terms of what excites me most about an exploration opportunity.
Mm. Grade, jurisdiction, anything else that comes on top of that?
Yeah, those are all important factors. Don't get me wrong, but I think that ultimately, like, top of the list, if you will, for me, is scale. You want to have good grade. That goes without saying. You want to be in a jurisdiction where there's no uncertainty or minimal chance of, say, the asset being expropriated, or maybe the challenges of permitting aren't so great or aren't so onerous, right? Like, all of that obviously is part of it as well. But in terms of what I think as an investor, again, that's going to kind of be the greatest value creator, right? If you can demonstrate to the market, and we can point to like Snowline, right? And going back several years ago now to Great Bear, I think the reason why the market latched onto those stories is simply scale, right? Snowline, I can't remember how many ounces they're sitting at in terms of, arm waving figure, but I've heard with the Dixie project, they're sitting, closer to 8 or 9 or 10 million ounces in terms of a resource. So, that to me is what makes or gets the market excited. And I think that's what the market will pay up for, right? Is that potential to grow up and for scale.
Right. And that's exactly what I want to talk about, because I've heard about Snowline 50, 100 million ounces, right? Silly numbers like that. That maybe, I mean, what do I know? Maybe there's 100 million ounces there. Who knows? Sounds silly saying it out loud, but um, how do you judge between that? Like, how do you even judge scale? How do you know if there's 10 or 1 million ounces?
That is a question best reserved for the geologist,
Mm.
definitely, and not me. But what I get the value out of talking to a client who, say, is a geologist, to say, okay, what is your interpretation here? How big might this be, right? And then I put my capital markets hat on to say, okay, well, here's the market cap today, right? Here's their valuation today. Is that fair and reasonable based on the potential for the asset, right? That's where I kind of come in terms of giving my interpretation and or my assessment of, does this constitute, or is this a reasonable investment? So that's my strengths, if you will.
But so you also pay attention to market dynamics, if you will, supply demand fundamentals of the underlying market.
Specifically, like, to the capital markets and not like commodity, right?
No commodity, I mean supply and demand fund. Like if you're looking into something that like a uranium story, if it's 2018, maybe you're not jumping on it, but it's 2020, then you're jumping on it because the case is much stronger. Or yeah.
Correct. Yeah. And there have been commodities that I've shied away from. Let's put it that way, over the last year or two, simply because I thought the outlook isn't as favorable for that specific commodity. So time is on my side. It's serving me well to sit on the sidelines, because I don't think that commodity is going to appreciate much, if at all, over some period of time, right?
Mm.
A great example, look at the lithium space over the last year, right? Pretty well not touched anything in the lithium space. Pretty well, actually, from the get-go. I mean, missed the first leg up back in 2016, but was or I should say, I've now got it on my radar because I think it's a commodity probably over the long term that will do well, or there's some potential upside there. But I think time is on my side, and just sitting back and kind of assessing what are some of the investment opportunities that exist today that maybe I want to buy at some point in the not too distant future, if or when I believe the time is right. Right. Again, hitting that inflection point for say the commodity, because this business is so cyclical. Like you could be too early, right, into a commodity or into a trade, and it's effectively the same as being wrong, right? Especially with our industry, be it as again capital intensive as it is, you could be diluted down here pretty quick, right? If the company consistently has to raise money at increasingly more expensive terms, it just works against you, right? Like you're going to be diluted out as a shareholder.
But at the same time, how do you manage that? That's something that I've been wondering about brokers, is that obviously you want to be selling what's hot commodity. That's what you want to be selling right now, because that's where, the more people are going to be trading it, because most people don't like being contrarians. But then stuff that Rick Rule has told me come in my mind, whereas you're either going to be a contrarian or you will be a victim. But almost by definition, as a broker, you cannot afford to be a contrarian, because then nobody's going to be transacting. So you're not going to be making any fees because you're always buying what's unloved. So how do you manage being a contrarian with being a topical investor?
Yeah, good point. And it sounds crazy to say, but I go back to the point of looking at the business practice from kind of a longer term outlook or view, right? If you consistently were putting deal flow in front of clients on sectors that were really hot at the time, right? The flavor of the month. It doesn't take, or it probably won't take too long before at some point you kind of get caught, right? Having bought at or near the peak. And next thing you know, you're staring at a loss of,
Hmm.
30, 40, 50+%, right? So I would say at the end of the day, right, if we are going to make investments into a company, I ideally want to do so again at that inflection point. The management teams that are the most capable, that have again the skill set, track record, so forth, they're always going to have access to capital. It's the ticket sizes, the abundance of capital isn't going to be what it once was, but they're always going to have access to capital. So I'll point to the Discovery Group of companies, right? So John Robbins, Jim Pedersen, and group. Um, you know, they raised money through, I guess it would have been 20, or I should say that, pardon me, Great Bear was under that umbrella. Great Bear managed to raise money 2017, 2018, I believe it was, when the discovery was made. That to me is a testament to great people will be able to draw or have access to capital. Yes, it was a tremendous success, right, from an exploration point of view, and looks to be a world-class discovery. They had the ability to raise something like, I think if I remember correctly, it was about $130 million over the period of about 3 or 4 years in what was a mediocre mining market at the time, right? So there's always going to be capital there. Again, I think for the best management teams, it's just not going to be to the same scale as it would be in a hot market. And quite frankly, in a hot market, look, anybody, if today, let's say somebody were to launch an AI deal, John Smith off the street, who maybe has no business acumen or any kind of track record or skill set or ability to actually execute on an AI related business, he'll probably have access to money, but what good does that do, right? It may as well incinerate that money as an investor, because it's probably not going to serve you very well as in terms of making the investment in the company.
Yeah. And okay, so it again comes down to figuring out if your broker is in it for the long term, basically. And if they're in it, yeah, go ahead.
I think so. Yeah, I think so.
Mm. Because if they're in it for the long run, then yeah, I mean they don't want to be mentioning selling stuff that are at or near a top. How do you manage that for yourself more specifically? Like when uranium, for example, when do you start pushing uranium? Because maybe you come across it in 2018, but you think like nobody's gonna care. I mean, this is dead. I'm not gonna sell anything. So right now, I might be better off selling I think vanadium was running in 2018 or something along those lines. But then obviously you don't want to be selling vanadium at or near a top. So how do you, where's that sweet spot? Because I suppose investors are also looking for that sweet spot where maybe you don't want to get in uranium in 2014 and wait for 6 years before anything good happens. So where's that sweet spot for you?
Yeah, good question. So I would say my approach has been, let's say you're, as a contrarian investor, let's say prices are depressed. You're perhaps a little early, but you think the long-term outlook looks favorable. I would gravitate towards those names that are, if you will, leaders in the space, leaders in the industry. So the lowest cost producer, let's say, a company that has a strong enough balance sheet that can sustain the business even with, say, depressed commodity prices over some period of time, right? So I would approach clients first with that. That's probably as an investment opportunity. Like, here's my investment thesis. I know the commodity is depressed, or I know the sentiment around the sector is pretty awful. But here's where, if I am correct, right? There's always the risk that we're wrong here. But if I am correct, capital is going to be drawn to, I think, this name first because it's the leader in the space. And we don't have to go too far. Look back. What was it, 3-4 weeks ago, Stanley Druckenmiller was announced that through financial disclosure, he's been a buyer of, I believe it was Newmont through Q4 of last year, right? Why is he gravitating towards that name, right? Well, I watched your interview with Cam Curry, and Cam's like, well, I don't think they should be buying Newmont, but I think they're probably drawn to that name because it's probably the most liquid name, right? When you've got so many millions to deploy as a generalist investor, you've got to be drawn, I think, to likely the most liquid name, right? So as a generalist investor, or I should say, looking at generalist investors, if we now commodity specific or resource sector specific investors say, okay, 2018, 2019, we're early on the uranium trade, but I think you got to stick with, Cameco because they are one of the lowest cost producers globally. It's the most recognized name in the space. Generalist investors are going to gravitate towards the same first. Well, I don't have the shareholder registry in front of me in terms of institutional shareholders, but I make a sizable bet that I bet you, if anything, the institutional investors have been gravitating towards Cameco over little uranium explorer co with market cap of $10 million and maybe some prospective looking project in the Athabasca Basin. So yes, you're early in the trade, get involved in something that's a leader in the sector, and then perhaps at some point layer into those more speculative investments if it's suitable, if your risk tolerance is there, and participate on the way up.
And now you're introducing sort of a new concept, if you will, for this conversation, which is capital flows, which is something I've also started paying more and more attention to. And this maybe fits well within the topic of top-down versus bottom-up investing. Like, where do you start? Do you start at the asset level? Like, does this asset have geological merit and does it have a team behind it that can finance exploration on it to grow it? Or do you start sort of top down where it's like nuclear energy expansion, uranium shortage? So let's go into those bigger names. What do you find yourself doing more, top down or bottom up?
Top down. Top down.
Okay.
I think it's, I use the analogy of swimming against the current, right? Look at most explorcos, right? Base metal, precious metal over the course of the last year and a half. Again, back to the point where they might have had some success in terms of exploration efforts, but the market wasn't rewarding them, right? In fact, it was a sell on news event, right? It was a liquidity event because the market fully was aware or knew that, okay, you spent $2 million, say, on your exploration budget this summer. You're down to your last million. The financing is in order. I'm going to sell the stock in advance of the financing, right? Very different, obviously, in a bull market where it's like for every dollar that goes in the ground, again, if it's successful in terms of exploration efforts, you should get much more than a dollar coming out in the form of market cap creation or value creation, right? So I've gravitated towards top down simply because I want to be, if you will, kind of in the story or in the commodity or in the sector when the current shifts, right? And the flow of capital comes into the space. That's been my approach.
Yeah, I used to have that approach too. I no longer agree with that for my personal portfolio, though I suspect it might be a sane approach for most people out there. What I mean by that is that you look at gold or copper or whatever, they haven't done too well. But then you look at Lundin Gold and NGEX and Filo and whatever. Had you caught that early on, and they were catchable, if that's a word, if you knew what you were doing, if you had spent enough time understanding the geological potential of the Vicuña district, you made money in a bad market and you outperformed pretty much every high finance money manager out there, which is why I
Yeah.
gravitate myself more towards bottom up, but it is harder. um
It's you're looking for alpha as opposed to looking for beta plays, right?
yeah,
And alpha is so hard because exploration is already an incredibly risky business to begin with,
yeah,
right? What are the odds? I think it's like one in every thousand kind of mineral showings actually turn out to be, some sort of resource defined from that, or some sort of resources discovered, and then one of every thousands out of those actually go into production. So your odds really from a mineral showing to going into exploration are one in a million, right? Like incredibly, incredibly high odds against you. Not to say that, to your point, that you can't make money invested in the right deal if they have tremendous geological potential and or success. And you know what? Quite frankly, like for let's speculate here for a moment. What if, let's say, the discoveries that Filo made and NG exploration and so forth, what if it wasn't a Lundin group of companies, right? Would they have had the same success from kind of a shareholder or price appreciation point of view? I don't know, right? Like obviously
no,
there's a lot
actually
of
there was I'm sorry for interrupting here, but the answer is no, because Dave Lotan recently gave a presentation on that in Toronto while I was there, talking about these things and clearly showing. They did a little study with Luke Denhoff from golddiscovery.com. Shout out to him. They did a little study showing what companies had performed well, like what number of companies. They gathered it all together, and it was a very clear thing that, um, what do they call them? They call them, like, this is like sort of a group. You can call it club or a group, if you will, that uh, manages or brings companies to market. It's clear that you see the Rosbeaties, the Pierre Lassans, the Lundins, the La Manchas. They're the people who make stocks go up, to put it in the simplest terms, right? So, um, yes, it absolutely has mattered that it was the Lundins, but it goes back to the team, and this is sort of again a bottom up approach where you start at the asset level, and then the second step is a team or whatever works best for people for first, second step. But yeah, continue. I'm sorry for interrupting you there. It's just something that I very recently listened to last week, so that's why I wanted to bring it up.
Yeah, no, I think I kind of expanded all my thoughts there that I could, but um, yeah, look, I have turned down. With that being said, I have turned down investments that were management teams that I would gladly support, right, and invest in, but I just thought the timing wasn't right,
Hmm.
right. So I do kind of, as much as I say management or people over everything in terms of my criteria, right, looking at an investment, I'm also conscientious of the thought that, or the thinking that I also want to be, again, trying to ideally hit that inflection point, right? And or I don't want to be stuck in a company that is never going to get traction, and we're going to be diluted down as shareholders, and it's just kind of this vicious cycle. Like I want to avoid those at all costs too.
Hmm. Right. Okay. Is diversification part of all that? Like, if say 3 out of the 6 deals you're working on are already looking for uranium, and a fourth one crosses your desk, but it's easy to sell uranium right now. I mean, it's never easy to get capital, to raise capital, but it's easier to raise capital for uranium right now than it is for lithium. Would you take that fourth deal and make it 4 out of 7 uranium, or would you look to diversify sort of on principle?
Yeah, I think I would probably want to high grade my investments, meaning, at some point, obviously, there's only so much exposure you would want to say. Personally, now I'm thinking only so much exposure to one commodity, right? And so if I'm looking at, got exposure to 3 uranium deals and looking at a fourth, it's like, well, is this fourth any better than the third, if you will, or any better than one of the three that we currently are positioned in? If so, then it possibly means rotating out of one name and into the other, right? I just don't necessarily want to keep adding capital to a theme just because it's hot and or you know it appears to be a sector that's trending the right way. Always want to be kind of, again, high grading the portfolio into names that I think will offer us the greatest upside given some sort of level of risk.
Okay. What's um what's what's the sector that's crossing your desk most right now? Is it uranium?
Crossing my desk in terms of deal flow or in terms
Yeah.
of what's of most interest to me?
Deal flow. Like
Yeah.
what are
So
people looking like in terms of raising capital? Let's get that was a vague question. I'm sorry about that. Get more specific. What is the companies that are looking for capital? What are they operating in the most? Like, is it uranium or another commodity?
yeah, I always see deal flow for gold and copper specifically. Like that just seems to be common, if you will, theme, good market, bad market. Certainly have seen more deal flow for uranium explorcos of late, over the last, say, 6 months. Certainly. Outside of that, it's kind of like these little odd ones here and there, right? So uranium, certainly a bit of a pickup, just given the performance of the commodity itself. And I think a lot of uranium equities, over the last 6 to 9 months have done well. And then always gold and copper, though, and silver too, actually, also, pardon, to some degree or extent. But I wouldn't say I'm inundated with solely uranium deal flow, no,
Hmm.
by no means.
Okay. And that's on the issuer side. What about on investors' side? What do they want to hear the most about? Like, do people ever ring you up and say, "Hey, what do you have in that sector? I want to deploy some capital."
Yeah, that does come through occasionally.
Okay.
Absolutely. I would say, quite frankly, though, let's talk maybe about the general kind of landscape of the market. The mining sector. Retail investors aren't really present right now. Like,
Hmm.
simply put, like, just not present. And so I would say probably not a lot of inbound phone calls from clients looking for specific deal flow and/or asking me what I've got, if you will. The retail investors just simply kind of checked out from the mining sector, and that process started, a year, maybe 16 months ago.
Okay. What then is easiest to sell? Like when you're reaching out to someone, what do you find easiest to sell?
Yeah, great question. I would say if there's any kind of interest right now, and recency bias here right now, but right now, if anything, people are kind of interested in the gold space. But again, that's just because gold's performance over the last, give or take, 2 weeks.
Okay.
This morning we hit 2,200 an ounce. So I think that's going to draw people's attention back to the sector in some capacity. So I think that's one quote unquote easier sell, or more topical investment idea right now. But yeah, there's been no real kind of standout over the last 6 months to 9 months, besides perhaps uranium, from, again, traditional kind of copper, gold, and silver.
Okay. What's then hardest to raise capital for? Is it lithium or nickel or one of the battery metals?
Probably. I mean,
Okay.
I really don't see much in the way of deal flow on nickel. Got something actually that came across my desk just the other morning. Lithium space, like, doesn't even really come up in terms of conversation with clients.
Hmm.
Um, Anything, quite frankly, that's early stage exploration, generally speaking, there's not an abundance of capital for right now. Again, the really quality management teams will always have access to some level of capital, but there's just not an abundance for it or of it right now.
Interesting. So if I were to be a contrarian, you basically putting me in the direction of early stage nickel exploration companies, which I hate too, because they mostly fail. But interesting.
Yeah, it looked tough game, right? Like, let's say hypothetically you're correct. Let's say that's the segment of the market that we want to be in. I'm not suggesting this by any means, but let's just say hypothetically. Now the question becomes when. When do things turn,
Hmm.
right? So if we're a nickel exploration company, and again, capital intensive business, let's say they have access to $1 million, they have some success with the drill bit, but the market doesn't care. So now you're raising money at perhaps the same price level on a price per share basis. Maybe, in fact, you have to raise money at a lower price per share. So now we, as existing shareholders, get diluted down, and that actually reduces our upside, right? So it's a tricky one. Like, I wish I could say concretely, what's the exact playbook, if you will, in terms of um, how do you put yourself in the best position possible as an investor for success in the space. There's no secret formula. It's a function of, though, I think, good timing, function of investing in the right people, the right commodity, Like there's so many elements that come into play in terms of ultimately a successful investment.
And that's what we've been talking about here throughout this conversation, I suppose, is all these things. But do you think that retail investors even have a chance if they're not accredited investors, or if as far as I understand it, you only deal with accredited investors, so people who or like how does that work? Can anyone sign up with you?
Right. So my business practice, if you will, I'm open to doing business with anybody. Do not have to be an accredited investor.
Okay.
But being an accredited investor does put you, I think, in a better position. One, because you have the ability, again, depending on your risk tolerance and suitability, but it does put you in a better position to participate in financings, right? And so, part of and maybe people aren't really aware of this, especially if they don't participate in financings, but part of the allure, if you will, or the advantage to investing in a financing is oftentimes there's a warrant or a part warrant attached to that financing, say, unit. And so we as investors get, further compensated for participating in the financing, because if the company does well, not only do you do well as a shareholder, but you're, if you will, bonused by having that warrant as, essentially risk-free upside, right? So as investors, if you are accredited, I think you are in a somewhat advantageous position when you do have access to financings in the form of, say, unit financing.
Somewhat advantageous position sounds like not a make it or break it type of thing. So is that what you think? Like, can a retail investor, without participating in private placements, still do well and not lose their shirt in this market?
Not lose their shirt, I guess. If the market is okay, then hopefully they don't. But it I would say is more difficult. It's simply put more difficult. I can think back to times where, investments that we've made and say a mining issuer has done well and the share price has gone from, X to X. But then again, to, juice your returns through a warrant, like it just puts you in that much better position. Would you want a return of 100% or 125%? Right? Like it, again, when things go well, having a warrant, having that optionality of upside, risk-free upside, it just puts you as a shareholder or an investor in a better position.
Okay. Fair point. I'm just thinking about how well, as I said, fair point, but I'm just thinking about how fair really this whole thing is. But that's potentially a conversation for a different time, as in, and you can have better returns if you already had good returns, sort of a bottleneck, if that makes sense. Like
Right.
you can only have better returns if you're already rich, basically, which is what accredited investors are.
Yeah, maybe to touch on that real quick, Antonio, there's
Sure.
certainly been a push from the industry to make the access to capital by the issuers easier. So there's now a life exemption, and it's called a life exemption, basically that the some issuers can use that allow even non-accredited investors to participate in the financing. Okay. So the industry as a whole wants to make it more accessible to the non-accredited investor to invest in be it the industry and or kind of across the TSX venture, right? So there's definitely been that push by the industry.
But that's a conversation in and of itself too, because I can see why the industry would like more people to trade in it, because again, commissions and fees and all that, it stacks up, right? But then the question also is like, do we want private placements or whatever to be available on like Robinhood type of platforms? Is that the best thing for the investor? I don't know. I have no idea. It's just obviously some deeper conversations, I suppose.
We can expand that conversation and say, well, Robinhood investors having access to like these altcoins, is that really the best thing for them as well, right?
Mm.
Like it's one of those things where, where do we draw the line, right? Where do we simply draw the line? I mean, again, the mining sector is certainly has its element of risk, and it's a high risk kind of sector. But does that mean it shouldn't be accessible by the retail investor? Like, I don't know, it's almost like a rhetorical question, if you will. I
Mm.
just simply don't know the answer, but it's definitely something that the industry as as a whole would like to see in terms of a push.
Yeah. Altcoins, that's where I draw the line, let me tell you that much. Um, Personally. But there's also been sort of two big topics out there as of recently where there's sort of a push from the industry um, for the regulator to do something, and one of those has been naked short selling, which I don't understand. I always just kind of saw them as, I won't get your thoughts on that, but I kind of always saw them as crappy companies going down, which in my opinion is a good thing. And then I also the other push is for getting pension funds, basically making it obligatory for them to put money into the mining space. And I don't think that more regulation is necessarily, I mean, making people do things is, in my opinion, fundamentally wrong. What do I know? People are not here to listen to me. What do you think about these two issues?
Yeah, so I'll touch on the naked short thing first. I'll tell you this, as someone who at times will help facilitate a short trade for a client, it's not simple. Like it's not simple. You actually have to secure a borrow in advance of putting a short trade through,
Mm.
which I would say more than 9 times out of 10 is impossible to secure. Now I know there was this there's a story you could probably Google and find out, but a fund that if I remember correctly, was based out of Toronto that was performing, naked short selling through, a subsidiary out in Ireland, and it was very complex and convoluted. Like maybe that's a one-off example, and they figured out a loophole. But there's been, I think that fund is maybe dissolved or whatever. But anyways, all to say that naked shorting, I don't think is actually material to the performance of our sector. Like it's just, I don't think it's that 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 thing, if you will, that's led to the poor performance of certain issuers.
Yeah.
Simply put, I think at the end of the day, it's a larger number of sellers and or one seller with a greater number of shares than what's out there that's willing to buy at a prevailing price, right?
Mm.
So yeah, I just don't agree with that. And then as far as kind of the pension funds goes, I mean, look, like be it in Canada, be it that there's obviously a large number of people within Canada that rely on, some sort of pension to, allow them to live post-retirement. Do we really, as a society now, like I'm not talking as an industry, as a society, do we want our pension funds to support an industry which up until now hasn't generated the best returns for its investors?
Mm.
Like, is that something that we want? Because now, if that's the case, well, let's say history does repeat, and let's say the industry as a whole, doesn't really perform all that well, at least relative to other indices and or benchmarks. And now you're going to have all of these outstanding pension liabilities. Like, then what? Like, what do we do then, right? I would rather, not being quite frankly educated enough on it, but from a very kind of high 30,000-foot view, I would rather that the pension funds invest as they see fit, like that the managers invest in a manner that matches their mandate and as they see fit, and there's no kind of politics or anything involved to kind of dictate how they invest capital as they see as the most appropriate way to do so. So yeah, no, I don't agree with that thinking that our pension funds should be allocating capital to the space in support of the industry. At the end of the day, I think the industry's got to perform. It's got to perform on multiple levels, be it ESG, be it obviously for shareholders. And if it does, then that will draw capital back into the space. If investors see a way to profit off of an investment, it'll draw money. Look at we kind of joke around about these altcoins, but look at what some altcoins do, right? At the end of the day, people will look at the performance of whatever altcoin you want to pick, and all of a sudden there's millions of dollars that flow into this one altcoin, obviously on the back of speculation. But that's exactly what that is. It's investors looking for what they deem to be a favorable rate of return given some sort of level of risk, right? Why can't our industry just kind of aim for that? Simply put, like, why can't our industry just say we need to do better and not look for handouts from essentially the government?
That's pretty much how I view it, and maybe I am being sort of a naive Gen Z desk rat that's never been to a mine site. Then those are all facts. But the way I see it is that those two issues, and why I brought them up together as opposed to separately, is because both of those two things are easily solved by us doing better, not sinking capital in projects that off the get-go the management knows this thing is never going to work. It's never going to be
Right.
a mine. And most management teams, I asked a bunch of people that same question at PDAC, asking, what do you think? Do most people make an honest effort to find a mine, or do most people make an honest effort to find themselves a well-paying job? And most of them look after themselves, right? A lot of them know that what they're sitting on is never going to be a mine. Maybe there's some grade, maybe there's something that you can tell a little bit of a story behind. You keep raising capital, you keep diluting people, the stock keeps falling, and then you keep complaining about that stock falling, and then you keep complaining about pension funds not giving you their money, right? And it kind of
Mhm.
gets silly. In the first place, it's because you're not developing anything of real merit. I mean, if this was a farm or something, and someone wanted to raise capital to milk bugs or whatever, nobody's going to give them that money because they're not going to milk the bugs. They're not going to make milk out of that, right? They have to have actual cows to make the milk from and make the money. I'm probably overstepping, and I have no idea what I'm talking about. But I think that those two things are easily solved with us doing better. And the question is, how do we do better? But that's again a conversation for a different time, I suppose.
Yeah. Yeah. No, I agree.
Yeah, it's been good. It's been good talking to you. I'm sorry that I have spoken so much. I should have let you speak more, but I always appreciate um a different view on things. What am I forgetting to ask you here? What did you come here hoping to talk about, but I'm not bringing up?
Yeah. Yeah. Thank you, Antonio, and for the opportunity to chat. It's been a little while since you and I chatted. There was nothing specific I would say that I wanted to talk about other than to kind of give, I guess, a lot of people who look to you for obviously interviews with kind of industry or thought leaders, maybe from the perspective now of a retail advisor. What are some of the, if you will, the ins and outs of the industry? What are some of the things that they're not quite aware of, right? And what are maybe some of the ways in which they can possibly improve, if you will, their investment returns and or put themselves in a better position to, obviously earn or generate better returns. Maybe one thing I can kind of offer, if you will, in terms of advice, very kind of generic, high level, but I would say if you're a retail investor and you don't work with a full service broker and you're, if you will, a do it yourself investor, I would say go out there and educate yourself, right? Start from the very basics, educate yourself about the sector, about the industry, a specific commodity, if that's what you're looking at. And then really try to, and this is the tricky part, full disclosure, but, try to decipher between the advocates versus the analysts, if you will, right? Some people will always be, gold bugs, if you will, and doesn't matter. It's never a bad time to, buy gold. Go into a car dealership and ask a guy if it's a bad time to buy a car. What do you think he's going to tell you, right? So try to figure out whether someone is an advocate or an analyst, right? And I really try to, myself at least now, try to be an analyst about, our industry, the sector. Like try to look at it from as non subjective point of view as possible, with as minimal biases, if you will, as possible, to say, okay, where can I allocate my own personal capital as well as that of clients, and or make recommendations or suggestions to, again, generate us a very reasonable rate of return given some sort of level of risk. And so if you can educate yourself, if you can figure out, again, who's an analyst versus who's an advocate, who's promoting you, if you will, in the deal, I think immediately you start to improve your odds of success as an investor.